All right, everyone, welcome. Thank you for joining us today. I am thrilled to have a guest here, Mary Ann Bartels. Mary Ann, thank you for joining us and taking time out of your day to kind of give us a market update. What's going on with the stock market, bond market, the Fed, everything economic. So first, just by way of introduction, Mary Ann has over 35 years experience. She is the former head of technical and market analysis at Merrill Lynch. And also while at Merrill Lynch, she was the head of the investment research committee. Mary and I went back and actually looked. It was almost 6 years ago, 2016. I was at a Merrill Lynch conference. You came out to give a market update. I forget what the music was, but it was blaring. It was high energy. And I'll never forget this. You said, if you want to make a lot of money, invest in growth stocks, specifically technology and semiconductors. And that always has stuck with me because a lot of strategists kind of stay in the middle and don't really, go out on a limb. And the amount of conviction that you had led us to take that away and overweight growth stocks. And for the last 6 years, we made clients a lot of money. So here we are today, very different environment. First of all, thanks for taking time. Thanks for joining us.
Oh, you're very welcome. Yes, it is a very different environment. In fact, unfortunately, we're in a bear market for stocks and bonds, and a bear market being defined by down 20% or more. And I went back to see the last time we had a bear market in both, because normally bonds will cushion a portfolio when stocks are very volatile. So we don't see them in bear markets together very often. I had to go all the way back to the early 80s, around 82, before we had a bear market in both. So we do have a bear market in both asset classes. Growth is probably not going to work in a bear market. It will work in a bull market still. So I think having a value tilt during a market correction is probably the better way to go. But the good news, there's actually, bear markets are just not fun, right? Bull markets are fun. Bear markets are just not fun, right? Even riding the bull is not fun, right?
Yeah.
So, but the good news is when we take a very long-term perspective, they don't last forever, right? So this is not going to last forever, but we're not finished through the process. And why are we in this bear market is probably the most important thing to discuss, if that's okay.
Yeah, I'd love that.
So we have inflation now at level, which I'm sure everybody has heard by now, that we haven't seen in 40 years. And the chairman of the Federal Reserve, Jerome Powell, came out recently during his press conference after the Fed raised rates 75 basis points for the third consecutive time, stating that they are going to break the back of inflation. And he had a very key kind of subliminal message in there. He said twice, we're going to keep at it. And why that phrase is important is in the 70s and 80s, when we had inflation, the Fed chair that got the credit for bringing down inflation was Paul Volcker. And when he wrote his autobiography, he titled it Keeping at It. So Powell basically referenced Volcker twice. So he's committed, meaning Powell's committed, to getting inflation down to their target range of 2%. So how did they do that? Historically, the Fed doesn't have a lot of tools, and their main tool is raising interest rates. So when you hear people talk about the target rate, that's the Fed funds or the short-term rate. Right. And Powell actually said in his press conference that he personally believed that rate would be 4.6% by early next year.
And so where are we now, just for reference?
4.3. So what's happening, it was much lower when he spoke. It is very rare that a Fed chair gives you so much clear information. They're being very clear, very precise. And unfortunately, they're even using the term pain. So in their press conference in August, coming out of Jackson Hole, the word that Powell used was pain, that there's going to be pain as they adjust for inflation. So the Fed has been very clear, very precise in their message. In fact, today, there are a number of Fed governors speaking, and they continue to have an extremely what we call hawkish or negative tone. So we're looking, right? We're not even forecasting the rates. The Fed is telling us.
Yeah.
Short rates are going to 4.6%. They stand in the marketplace today at 4.3. So the market is pushing the rates. But what we're seeing is that the yield curve, meaning all the maturities on the yield curve, are rising. So the yield curve is shifting up.
Yeah.
And I'd have to say, in my career, this is probably one of the most aggressive periods that I've ever seen. I entered Wall Street in 1985. So we were on the other side of inflation. We were lowering rates. So I grew up during inflation. I remember my dad complaining that with every paycheck, it was worth less. And I had a hard time wrapping my head around it because the numbers didn't change. It took a degree in economics to understand losing purchasing power.
Yeah.
But the Fed will keep at it. We'll get inflation down. It's not going to last forever. I believe, and this is, a guesstimate on my part, that we're probably about 3/4 of the way through. So we're more than halfway through. I think we'll get a bottom in markets somewhere between the second and third quarter of next year.
Okay, so just to jump in real quick, because I'm charting a few things. So I have year to date, you mentioned pain, we're down 22% this year, the S&P rather. Even in the last month, we're down around 10. So if you're going back, say, 3 years, you still have stocks up about 28, 29%, but you're saying that you might see another 10% drop from here, which would put us, pre-COVID, so early 2020 numbers on the S&P.
Exactly. So what the Fed really will be doing is taking away that kind of COVID stimulus and resetting prices back to pre-COVID. That would put the markets down. The estimate that I'm using is around the worst that I'm getting is about 3,200 on the S&P. That would be down off the highs around 33%. Historically, going back to 1929, the average bear market is down 37%. This is really all very normal. I know it's not easy to go through,
right?
But in order to have the bull, we traditionally have the bear. It's just that the Fed has been able to stimulate the economy for a long time, so markets have recovered very quickly when they've gone down. What's going to feel bad is we're not going down quickly. It's going to take a while to readjust. And that's where the pain comes in.
The other pain comes in is we're not getting reprieve from bonds where you typically would. So here we have the bond market, the Lehman Ag, down almost 15%. And what I've charted before for clients is, as you mentioned, interest rates rising. So what I'm showing is the 10-year Treasury is up 142%. And that's the interest rates increasing. A 10-year Treasury in January, 1.5. We're now at that 4% number. That is massive. That's significant. And because of that, the price of existing bonds have dropped in value, which is why we're down 14. But with pain being a key theme here, if we just look at stocks versus bonds, the traditional 60-40, could you comment on that? Because we now have bonds down, stocks down. The way we manage portfolios for clients is we target an allocation based on time horizon, financial planning, and then when the market shifts and changes that portfolio, we're rebalancing, and that rebalancing forces us to sell high and buy low. Well, the last rebalance we did as a firm was back in March, and it was pretty significant, but we've continued to see stocks and bonds slide since then. So this is even a more abnormal market where, to your point, there's a bear market in stocks, a bear market in bonds. What do you think about the traditional 60-40 portfolio if we look forward? And that's all we can really do, right?
Exactly, because basically 60-40 was dead. The real asset allocation didn't feel like it was working because rates were so low. It actually did. Believe it or not, it did diversify. But because rates are going up, it's just not working for this period. So there was a phrase on Wall Street that was called TINA, and it stood for there is no other alternative, meaning that if you're looking for income and price appreciation, stocks were the only game in town.
Right.
by the Fed resetting or renormalizing interest rates, we're going to have TARA now, which stands for there are relative alternatives. So although we're going through this pain, some of the opportunities now across the fixed income spectrum are really going to be quite significant. I think in the fourth quarter, you're going to see a lot of rebalancing and being able to generate income, whether you do it from treasuries around 4%, or if you can go up the risk spectrum, some of those rates now are around 7 or 10%, but that's the much higher risk. And even in muni land, we're seeing even munis back up. So I think across all fixed income spectrum, we're going to get a 60-40 model of asset allocation back.
Okay. So would you expect more consistent returns out of bonds over the next 12 months relative to stocks?
I think we still have a few more months of challenges in the fixed income market, but in 2023, I think we'll have a reset back to where bonds look more attractive, because this is what the Fed does historically. They will raise rates until they really want a recession. They want to slow things down. They want to slow down employment. They want to get wages down, and what they want the consumer to slow down their spending. So they need a recession. They're going to force a recession is really what they're gunning for. Once they get that, they're going to start lowering rates. The other thing that can happen is if they don't get signs of a recession, but something breaks in the system somewhere, whether here domestically or internationally, they're going to lower rates. So we're going to get the Fed to lower rates again. In fact, today I was looking at what's called the 5-year break-evens. So this is looking at inflation expectations going forward. And 5 years is pretty reasonable going out. They're dramatically falling, which means the market believes that the Fed is going to be very successful in getting inflation down. And if they get inflation down, the next step will be to lower rates. Lowering rates will be very bullish for the bond market.
So you bring up something interesting, that if the Fed is going to raise rates to push us into recession, and they're aware of that, and likely will push us into that recession. Well, all of the headlines that, well, not all, but most headlines right now are indicating that. So if you're an investor, do you stay invested here, or do you add here, given that it looks like the common sense and the best case scenario is that we all are headed into recession if we're not already in one? So then even you think there might be 10% downside in stocks. Do we own stocks here? Do we buy stocks here? What's the advice?
If you haven't sold already, I think it's too late to sell at this point. This is the last leg. As I said, I think we're 3/4 of the way through. Now, why would I say that? Because in my years of experience, first of all, it's very hard to get two sides of the trade right. You have to get the sell right, and you have to get the buy right. The probability of a non-professional getting that correct is extremely low. And even the professionals, it's a 50-50 shot if they get that right. So that's the odds are not in your favor. Number two, the clients that I have seen panic and sell, because the news gets so bad at the bottom, or feels so bad at the bottom, they don't have the emotional ability to actually buy. And they don't get back in the market, and the market can rip, and they totally miss and have to buy way above where they sold.
Yeah.
In addition to that, if you're in a portfolio that is generating income and reinvesting that income, you're losing that reinvestment compounding opportunity. So if all the math shows to stay invested at this point, just stay calm, don't panic. But I think it's very appropriate to revisit your asset allocation in the fourth quarter, and if appropriate, to be doing some rebalancing and repositioning for 2023.
Yeah. I think that's great advice. And I've seen that as well. I've seen investors burned. Yes, they might have gotten out and missed some further decrease in the markets, but the point that they get back in is typically when they're more confident. When they're more confident is when things have already recovered past the point that they had exited. The other interesting point on the chart here is that the market bottomed during COVID in the March timeframe, yet we didn't have vaccines until the end of that year, or even early the next year. So sometimes markets will begin to recover while there's still really bad news out there. Could you see that happening here? Could you see a market recovery before the Fed's done increasing interest rates?
I think the market has to begin anticipating that the Fed's going to at least stop.
Okay.
Doesn't mean that the Fed says that they're going to stop, but if the market truly, because the market is a discounting mechanism, it tries to discount 6 months out. I think if the market begins to really believe that the Fed is very close to stopping raising rates and closer to cutting rates, the market will definitely bottom.
What about hitting new highs, right? If we look over the last 10 years, we've seen a number of periods of corrections, which are 10% drops. We've seen a bear market, a recession during the last 10 years, and we've seen the eventual recovery. So, I guess the layup question, will we hit new highs from what we experienced in January? When might you see that, number one? And then number two, where would you be positioning right now? And I'll pull up a growth versus value chart just to kind of add some context to those that are going to be watching this video. So will we hit new highs, Mary Ann? When could we hit new highs?
The answer is yes. I do believe we're in what's called a secular bull market. We will get new highs. They're not going to be anytime soon. I'm calling this kind of an old-fashioned traditional bear market. You might need an old-fashioned while you're working your way through this. And typically you get a market low, and it can take up to 6 months of a kind of like a sideways trading range. And then you can start rallying and eventually hit new highs. That would indicate somewhere maybe later 2023, 2024, we can get to new highs. While we're still in this, what I'm calling episodic volatility, as the Fed's in this tightening mode, you want to be in very high quality, probably higher up the cap. You want to be more value than growth. Once we bottom, and we're confident that we have a bottom, you're going to flip and you're going to go to growth.
Okay.
Growth is what traditionally rallies off the low, and small cap. So very different kind of profile. In fact, you want to go lowest quality, growth, small cap, when we're going to come off the bottom.
And we don't need to be perfect, right? We should hopefully see some signs of that, and maybe hear from you as well, because growth's been ugly this year. Yes, we did, and I helped make clients a lot of money per some of your recommendations dating back 6 years. We rebalanced in December. We paired growth in favor of value. We did more of that in March. In hindsight, we could have taken that step even further if we're looking at the latest rebalance that we did. But growth stocks down 31 as of today, so far year to date. Then you have value stocks down 13. You expect this trend to continue for several months?
I do. As long as the Fed is raising rates, we're going to have what's called episodic volatility. And I don't expect that to settle until sometime in the first half of next year. But I would be looking to reposition in growth. Why? There's a lot of tech in growth. I don't believe tech is dead. When we take a very, very, 50,000 feet up in the air view of what's driving our economy, we go back to the 1500s, it was agriculture. And the technology that they used was the sundial. That didn't shift until we created the steam engine and we went into the industrial period in the 1700s. We think that shifted in 2000 with the internet, right? So from industrial to internet was 300 years. So I think technology, the whole cycle of technology, is going to last hundreds of years. And you can see this. A car is not a car anymore. It's a computer on wheels, right? Everything is getting chipped. And I know this is going to sound a little weird. They're already chipping humans. You can Google this. In the Nordic region, people are being chipped. It's a rice-sized chip, kind of like right here. And they can do their banking. They can open up their doors. It has like all your personal coding information. everything in the world is going to get a chip. So, and there's more to that technology.
Sure.
So I do believe that high quality growth companies with good balance sheets, good cash flow, many of them paying dividends, will come roaring back. What will not come back are the high flying COVID kind of growth stocks with no earnings and, you know, PE multiples in the stratosphere.
Yeah.
That you definitely want to stay away from. In fact, if you own any of those in your portfolio, that's tax law. This is tax loss harvesting period. Wash them out.
Okay, good. Well, great. Any other last parting words of wisdom before we break here that you would share with investors? You know, I know some of your themes are stay patient, stay in equities. Anything else you would share for those listening that are scared, that are nervous, that are frustrated with how their portfolio has been performing, how the markets have been performing, and that's even accelerated in the last 2 weeks?
So I'm going to tell you what I do. I stopped looking at my portfolio. Just stop looking at it, because you're going to give yourself anxiety. Some people look at it on a daily basis. They're going to be on some form of medication if they do that. So stop looking at the portfolio, take a step back and look at it from an educated, reasonable framework, and then revisit, your goals. Why did you create the portfolio, right? Work with you and your team.
Sure.
Why did you create that portfolio? And, most portfolios probably only need a little bit of tweaking, not a massive dump. And all I can tell you is I've been in the market for many, many years. I came into the markets in 1985. My first experience of a bear market was the crash of 1987. Then we had a bear market in 1990 when Saddam Hussein invaded Kuwait. Then we had the S&L crisis and the bear market in bonds in the early 90s. In 97, we had a almost bear market with a crisis in Asia. Then we had a Russian default in 1998. Then we had the tech bubble in 2000. We had the financial crisis of 0809, right? I'm going to skip a few in between.
Sure. It happens.
It happens. Bear markets happen, and some of them are just painful. And this is going to be a painful one, but we recover. And the most important part is to remember, I believe we're still in what's called a secular uptrend. Secular uptrends can last 15 to 20 years. The greatest secular uptrend was from 82 to 2007. Then we went into a holding pattern. And of course, we had the financial crisis.
Sure.
We went into a secular bull market in 2013. We're less than 10 years in. I still think we have a lot more life to this market.
We'll end there. That's encouraging. Thank you very much. I'm honored to have you. I feel lucky to get 15, 20 minutes of your time. You're a legend. Thank you for sharing and taking time to do a little market update for our client base and for us here at Ausperity. So, Mary Ann, thank you. Have a great day. This really means a lot.
You're so welcome. My pleasure.
Great. Take care.
Bye-bye.
Thank you for watching our video. Please remember to subscribe to our YouTube channel. Look at our links below for ways of getting in contact us, and message us if you'd like us to add you to our monthly newsletter.